T-10 to showtime. On my mark, roll intro and mark. Camera's ready. Camera 1 check. Camera 2 check. Audio. Roll guest package. Action. The views and opinions expressed in this podcast are those of the individual speakers and do not necessarily reflect the official positions of Visa or the speaker's employers. This podcast is intended to provide general information and should not be considered health, legal, tax, or financial advice. Todd, coming to you in 3, 2, 1, action. This is Policy Sandbox, a collaborative space for ideation at the intersection of payments, commerce, and public policy. On this episode, we're going to talk about the end of the free trade consensus, geopolitical fragmentation, and how businesses are navigating these seas of uncertainty.
Go back to the 1930s, lots of friction, war, and then came, a period of 80 years of removing friction in the system. There's friction's back. We're going to figure out how to remove it.
That was Demetrios Marantis, a veteran of international trade and economic law who've spent well over 2 decades shaping the rules that govern global markets. Demetrios helps us explore the history of the multilateral trading system. But as the world fractures into economic blocks and trade rules struggle to keep pace with technological innovation, what I want to know is, has the golden age of globalization really gone for good? And if so, what's next? How do we adapt? Before we dive into the policy, let's consider the stakes. If governments get this right, who benefits? If they get this wrong, who pays the price? Although international trade is typically viewed as the domain of multinational corporations, the biggest winners of cross-border digital commerce are often small businesses, middle market companies, and consumers. To explain why this is the case, I invited my friend Dr. Kati Suominen to the Policy Sandbox. Kati is the perfect person to unpack this topic because she is an entrepreneur herself. She leads a small but extraordinarily impactful company that helps other small firms navigate global trade and financial markets. Her clients are the small business owners for whom going digital means going global. I wanted to hear from Kati how smaller companies experience volatility, fragmentation, and geopolitical shocks. When the global trade system fractures, shockwaves are felt all the way down to Main Street. Large corporations have risk teams to scenario plan for tariff volatility, but everyday entrepreneurs don't necessarily have the infrastructure to navigate different customs rules and regulatory frictions. Indeed, what they most need to support exports and drive cross-border growth is currently in short supply: stability. But to go deeper on this topic, let's go to my friend and mentor, Ambassador Demetrios Marantis. Ambassador Demetrios Marantis, my friend, my mentor, my colleague, welcome to Policy Sandbox.
It's great to be here.
Demetrios, right now, you have areas of expertise that cut across some of the biggest questions happening in geopolitics, payments, international finance, and really just life. We are living through a moment of great geopolitical volatility. Much of that volatility is being expressed through trade policy. The impact is falling onto small businesses that are involved in international trade, financial institutions that provide the capital and liquidity that makes international commerce possible, and ordinary people that are just trying to get through it all. And you are a person that knows a thing or two about all of the above. So when it comes to geopolitics, you and I obviously have been at the forefront of this issue in our professional careers for many years. You now as president of the National Foreign Trade Council Foundation, previously as head of corporate responsibility at JP Morgan Chase, before that as my boss here at Visa, and before that at Square, now known as Block. But really it was your public service that perhaps the most relevant piece of all. So I know that we'll get into this, but you were the acting United States trade representative. You were the chief trade counsel for the Democrats on the Senate Finance Committee, and you spent many, many years in the trenches of negotiating trade agreements around the world. Before we talk about what's happened over the last 12 months or even the last 12 days, I think it would be helpful to go back to where this whole concept even started. Students of American history or in the history of international commerce remember that it wasn't always the case that you can expect a tariff that is extremely low if there's a tariff at all. For much of human commercial history, there actually were very significant barriers to cross-border commerce. Why was it a good idea to get rid of those barriers? And why did people seem to change their mind about the wisdom of open markets and free trade?
Well, I'm so excited to be here, Todd. Thank you for having me. I think, to start answering that question, I think it's important to ground ourselves and to ground ourselves into what's happening right now, which is we really are in an unstable transition period between an era that lasted for 80 years and something that's coming. And we don't know what the rules are. We don't know how that story is going to be written, but we do know that we're in a very significant period of flux. And one of the, I would say, linchpins of the last 80 years was a commitment on the part of countries around the world to reduce their trade barriers, to promote globalization as a way of lifting their own populations, but also populations in the developing world out of poverty. And it was associated and really considered, I think, a key tenet in how do you make the world richer is by reducing trade barriers. And so for, since World War II until, 8 or 9 years ago, the animating principle of international economic relationship was let's reduce progressively trade barriers from the high levels that we saw in the 1930s pre-World War II to the very low levels that we saw, until the early 2000s. And there was a lot of great that came with that. So many countries around the world really were able to tackle poverty by creating opportunities for their populations to export, to grow their economies, and to, again, lift their populations out of a state of affairs that was hard. And so you get to the 1990s, which became really synonymous with globalization, where countries around the world were trying, one after another to enter into multilateral trade agreements, bilateral trade agreements, plurilateral trade agreements whose net result were reducing trade barriers. And that was all well and good, and it served an unbelievably important purpose. However, there were problems that emerged along the way. How do you integrate a huge economy like China into this system? How do you deal with market distortive practices that weren't covered by all of these beautiful international trade rules that were negotiated over an 80-year span? And so stresses and strains started to really form in the system, and those stresses and strain became major political issues. And so, fast forward to 2016, during the election in the United States between President Trump and Secretary Clinton, these issues really blew into the forefront. President Trump got elected and decided it was time to walk away from the architecture that was created during those 80 years. And that process has accelerated significantly in his second term. And now we're in a very new world where the United States, which was the leading proponent of reducing trade barriers, is the leading proponent of putting them back on and erecting a tariff wall around itself. And we're not sure yet how that story is going to play out, but that's sort of where we are today and a little bit of a snapshot of how we got there.
You're being very modest, of course. You weren't just observing this, you were negotiating a lot of these trade agreements. You actually were the principal negotiator of some of the most important and consequential free trade agreements certainly of the 21st century. I think that part of the reason why we needed good negotiators like you involved in this process is there has always been a little bit of a tension when it comes to opening a market that has a strong import competing domestic industry, pushing back against it. So maybe just talk a little bit about the jobs you've had, particularly at the Office of the U.S. Trade Representative, and what was this negotiating over trade really about?
So trade is a component of economic policy. It's a component of foreign policy. It's a component of just general macro policy that any country has. And how do you use commerce to make your economy better? And essentially that's what negotiating trade agreements was all about. It was, how can we increase opportunities for U.S. producers of whatever, whether it's farm products, whether it's services, whether it's goods, whether it's intellectual property. How do you make those exporters as competitive as possible in international markets? Why? Because that increases jobs. It buttresses Main Street. It makes the economy better. So in my career, I was very lucky to have worked at the Office of the U.S. Trade Representative as the Deputy U.S. Trade Representative and then as the Acting U.S. Trade Representative during the Obama administration. And before that, as you said, I looked at these issues from the congressional perspective as the Chief Trade Counsel for the Senate committee that was responsible for trade. And it was amazing. I mean, what an amazing opportunity that was to really be able to use trade as an instrument of larger policy that was helping make our own economy more competitive at the same time that was creating opportunities around the world for other countries to help lift themselves out of poverty. And so it was the real animating principle for us and for everybody in trade negotiations, including this administration, the last administration, and administrations before, was how do you use commerce as an instrument of helping improve economic competitiveness, boosting the creation of jobs, and just helping, make the world a better place.
What I didn't hear you say is that you were motivated by a desire to shrink the U.S. trade deficit, to raise tariff revenue as a way of offsetting potentially income tax or corporate tax. I didn't hear you mention that you were trying to obtain negotiating leverage for non-economic foreign policy priorities. Is that because those weren't topics of interest when you were leading the Office of the U.S. Trade Representative, or was that just somewhere on your list but maybe secondary to this idea of uplifting economies?
The most exciting thing about trade is that it's everything. It involves every single aspect of the economy. And you're always having to balance different priorities. And that's why Congress decided to put the Office of the United States Trade Representative inside of the White House, rather than have it be part of the Department of Treasury or the Department of State or the Department of Commerce, because each one of those agencies represents a different interest. The State Department represents foreign policy. The Treasury Department represents sort of macroeconomic policy. The Department of Agriculture represents farm policy. The U.S. Trade Representative had to balance all of those interests, come up with a negotiating position that made sense from the perspective of how are you creating more opportunities to export and create jobs in the U.S. And so many factors went into consideration, and it was really our job to work to really balance it, come up with a negotiating position and strategy to be able to achieve those aims.
So I think there's a reason why you had what many people consider, at least in the United States government, to be kind of the top job in trade. I had what I don't think many people would have considered the top job, but I too was involved in U.S. trade policy. When I was at the Commerce Department in the early 2000s, almost every day, another company came into my office and complained about how some foreign government was taking advantage of them. Either their intellectual property had been stolen, they were assured some kind of market access, but the promise was not kept. There was a genuine sense of frustration that the U.S. was providing a better overall package, admittedly with certain barriers and frictions, to a foreign company than a U.S. domiciled company was getting overseas. As much as there was a desire to help gain some market access for U.S. companies, there was always a higher priority, which was, look, in the scheme of things, we want a multilateral trading system that works for as many companies as possible. And even if there are some losers, there are also a lot of winners. And as long as there are more winners than losers, it's netting out on average to be a better deal for both the U.S. national interest and even for companies themselves. They may lose access to one market, but look at all the other ones. All the same complaints that I used to hear from these angry companies are now actually being said by the Secretary of Commerce, by your successors at the Office of the United States Trade Representative. I think from their perspective, it's almost as though they've said, look, nobody's been standing up for American business all these years, and now it's time that we do something about it. Is that a fair assessment, first of all? And then do you think that the way that this evolving policy around, say, tariffs and market access is in fact going to give those companies what they said they wanted?
I do think that's somewhat of a fair assessment in the sense that the idea was for the rules to work. The idea was for these wonderful rules that we were negotiating they were going to help everybody. They were going to help all U.S. exporters. And when there was a problem, there was going to be a vibrant and vigorous enforcement mechanism to deal with those problems. And the problem was all of these amazing rules that were negotiated, they didn't catch everything. And I think things changed radically in 2000 when China joined the World Trade Organization. It was a very heady period for globalization at that time. And again, the thought at the time was that the more countries participate in this wonderful multilateral global trade system, the better it is going to be for the promotion of democracy and for freedom, because global trade the increase in global trade will correspond with the reduction of limitations on personal freedom in the political space. That didn't happen. That's not how the story ended. What ended up happening is China, which has a huge economy, largely state subsidized, enters into this rules-based system. The rules were negotiated not to deal with that. And so all of a sudden you have the entry of a very powerful economic factor that the rules originally were not designed to deal with. And so slowly, as those distortions became more and more challenging and problematic for U.S. companies, more and more companies were complaining to the Todd Foxes about the problems they were having. We're being cheated on. No one's enforcing the rules. And so you end up between 2000 and around 2016 with this mounting frustration that we have these long-standing rules that do not work in every situation. So the question then you asked was, well, is this pivot that we have now, erecting a tariff wall, the right thing to do? My own view, no, it's not. It's creating a whole other set of problems. The right approach from my perspective would be to think about what are the actual problems we're facing and how do you address them? Do you knock down the whole system? No, you fix the problem. And I think the pendulum has swung in a very radical direction right now. I do think at some point the pendulum will swing back on these issues, and there'll be a recognition that these beautiful rules don't work in all circumstances. We need to figure out how to address the distortions and actually construct a forward-looking, macroeconomic and trade policy that can be durable, that doesn't have to be unilateral, and that can work for the U.S. and countries around the world.
Governments try to write rules based on their best view of what the economy looks like today. Maybe they can actually future-proof it a little bit, but one of the hardest problems is to try to write rules for, as we saw in the case that you just laid out, for this sort of multilateral trading system. It worked for about 80 years. It's pretty damn good in terms of how can someone in the late 1940s possibly imagine containerized shipping, 3D printing, data flows. It's an unbelievable testament to what happened at the Bretton Woods conference that they got as far as they did. Some innovations just simply were completely off the cognitive map of the original framers of the General Agreement on Tariffs and Trade. Even in the early 1990s, when the World Trade Organization was created, I really don't think anybody could have fathomed just how big the internet would become, or the smartphone. or now we're entering this world of AI-powered agents handling a lot of commerce without a human in the loop. This is like off the wildest fantasy of a trade negotiator in 1992. So it's really a question of future-proofing. Is it a fool's errand to think that we could come up with a trading system that is resilient against all this innovation?
When I was negotiating in the Obama administration, when we were thinking about digital trade and how fast the industry moves, and how you always feel as a negotiator, or even in government always, with respect to any new technology, you're answering yesterday's question and things have already moved on. I think what we've learned on this topic is that trade rules can't do everything. There is a defined space where you can have very robust trade rules and have them work. But to think that yesterday's trade agreement is going to cover what we're going to see tomorrow in AI is foolish. And I think there was really this effort from the WTO forward to think that trade in goods, trade in services, trade in agriculture products, trade in intellectual property, trade in this, trade in that, trade was everything. It does encompass everything. But when technology is moving so quickly, the second you negotiate a trade rule on AI, it's out of date the next day. And so I think, you have to think about where is the limit, where do you stop from a governmental perspective, and just kind of see how the whether it's AI or whatever goes.
So Demetrios, one of the things that you have always taught me in all of our work together over the years is that you've got to be for something. We're not just against one particular trade policy. We're actually for a vision of the world which is really driven by entrepreneurship and creating economic empowerment by giving the same opportunities to smaller businesses that exist for larger ones, giving the same opportunities for developing countries that used to really be the exclusive domain of the most prosperous industrial economies. And I think that being for that is something that we can agree is really a nonpartisan issue. I don't know too many economic nationalists that don't want to see small businesses thrive. We have a partner here at the Visa Economic Empowerment Institute, Dr. Kati Suominen, another great friend of ours who has done amazing work at this intersection of small business and international trade. And let's take a listen to what she and I discussed when we talked in advance of this episode.
The opportunities for small business to internationalize today, I would say, are unprecedented, historically speaking. So if we look back, say, 20 years or even 10 years, internationalization for small business was really a long and costly process. So let's imagine you're selling products. You would have to go to a trade show, you would have to travel to meet buyers, then you might get an order, and then you have to figure out, say, market access regulations. You may have to identify freight forwarders, orchestrate that export process. So in other words, there were very high fixed costs of gaining visibility with buyers and entering new markets. And this is why large businesses were much likelier to export at the time than small businesses. They were able to deal with these high fixed costs of market entry. Then, let's say 10 years ago, e-commerce and, of course, the internet really changed this. They reduced this fixed cost of gaining visibility with buyers. So if you think of a small business, they could get orders online through their online store. And of course, there were on the import side many more importers, because consumers could now themselves become importers and buy directly from small businesses without being, intermediated by department stores or retail chains and so forth. So in a way, the addressable market multiplied for small businesses. And so, today I would say small businesses can be born digital, and as a result can be born global. A lot of new challenges that businesses have to deal with that kind of add to the variable costs of doing global business. So For good sellers, of course, we all know about the tariff volatility over the past few years. The shifts in tariff rates or import classifications are making it harder for exporters to have predictable sourcing, for instance, and know that they are able to access markets in a predictable fashion. There is also this, I would say, greater scrutiny on where products came from and what the supply chains of businesses actually contain. And of course, there are sustainability related mandates as well, where markets like the European Union, for instance, require companies to have better understanding of the environmental impact of their supply chains. If we look at services like legal, financial, some other business services that are highly regulated, in those segments, businesses tend to face, say, licensing requirements or restrictions on cross-border provision of service or capital requirements, for instance, in the case of financial services. So again, these are raising the cost for small businesses in particular to break into new markets. And then the new set of rules that are related to digital economy and digital regulations. These rules, such as data privacy, data transfer rules, consumer protection rules, say content moderation rules, digital taxation rules, now AI rules as well, AI regulations, are further complicating the export opportunities, both for goods sellers as well as for services sellers. So overall, digitization is creating these magnificent opportunities for small business to internationalize, but at the same time, we have new sets of regulations and regulatory fragmentation that have to be dealt with in order for small businesses to take advantage of this digitized economy.
Fascinating, right? So what Kati is really saying is that you take a company, you make them digital, you're kind of making them global because the internet is global. And now with artificial intelligence and agentic commerce, the total addressable market for even a very small business is the entire world. But someone has to be working for those small businesses because they certainly don't have the scale and the wherewithal to operate a full stack legal and government affairs team in every country where they're doing business, especially if they don't even know what country they're doing business in because of the internet kind of solving that problem for them. How do you think about the role of digital payments when it comes to small business participation in international trade?
I mean, Todd, I'm really happy that you bring this up because at the end of the day, it's small businesses that suffer when they're not connected to the global payment system, to the global trade. There is a great market that a small business can have locally, but the opportunities abound if you can be connected, if things can be simple, easy, safe, trustworthy. For a small business to be able to participate in global commerce, it's a huge game changer. And talk to any small business about their experience in exporting. The easier we can make it for them, the more friction we can remove, the better it is for them, the better it is for Main Street, and the better it is for the global economy.
So I would love to get your thoughts about where globalization of digital payments is trending, especially in light of all the fragmentation that's happening in the world. Is this just something where we're destined for a second best outcome where every country has its own digital payment system, or can we still find a way to create that power that really comes from having ubiquitous acceptance and connectivity?
I think there's a tension. I think the tension is, I think what we're seeing in the world of geopolitics now, where countries are really looking to bolster their own resiliency, is you're seeing, I want to have my own fill in the blank. I want to have my own payments network. I want to have my own this. But then on the flip side, there's a realization that you can't really do that in today's world. So there's this effort to fragment. And then there's this reality that you need to have a form of interoperability in order to make things work for your customers, to make things work for your population. And so I think this tension between, self-sufficient resilience and the reality that in spite of everything, we live in a globalized world where people travel and are all over the place and companies are interconnected, that you still need to figure out how you maintain some form of interoperability. And I think that that's the dichotomy between the fragmentation on the one hand and the interoperability on the other hand. They seem like they're opposite concepts, but they actually lead back to one another.
Demetrios, we're almost out of time, but the Visa Economic Empowerment Institute is all about electronic value exchange. And that doesn't just come from me. That comes from the founder of Visa, Dee Hock, who had this idea that the electronification of money was going to be this massive flywheel for economic growth. And I think we live in a world that is better, certainly more prosperous, because distance and trust are largely getting solved by global payments. You experience this when you travel abroad and you've never met this merchant before, but you are happy to hand over a payment credential. You don't think that much about whether they will ever pay you back or defraud you, for one, because there's a lot of rules built into the payment brand itself, but also it's just something that we've been habituated to paying electronically. Removing all that friction of physical cash and conversions from this aspect of trade has actually been a massive driver of all kinds of economic opportunity. But you aren't necessarily focused only on retail payments. You're looking at this from a much larger perspective. So before we run out of time, Demetrios, maybe you could just share a bit with us. How does all this trade stuff resolve? Are we just doomed to a world where there's just a lot of tension between countries, or is there some reason for optimism that maybe we can do some version of electronic value exchange on that macro scale?
As much as I sound like doom and gloom a little bit when I talk about this, I'm actually super optimistic. I mean, you hit on the right word, which is friction. And the revolution of electronic payments in removing friction in commerce, it's the same thing that's happening in the world of trade. I mean, go back to the 1930s, lots of friction, war, and then came, a period of 80 years of removing friction in the system. There's friction's back. We're going to figure out how to remove it. We are in the U.S. in a phase where we're raising tariffs on everyone. Usually what has happened historically is when one country goes, it spirals upwards. In this case, most of the countries around the world are just keeping calm and carrying on and continuing to do their things, engaging with each other, thinking of, how to use trade to better their economies. That makes me very optimistic. We aren't in this crazy 1930s protectionist spiral right now. And that's a very good sign for what comes next. We have very different challenges right now in the global economic space, but there are a lot of smart people out there who are thinking about how do we go back to a more predictable, stable, macroeconomic world where commerce flows easily. And that's, I think, the goal of everyone.
That's certainly our goal. Demetrios, thank you so much for your time, and this has been a fantastic conversation.
Thank you.
That's it for this episode of Policy Sandbox, but I'm already looking forward to the next conversation to help us all understand not just what the next era of global payments will demand from us, but what it can offer us as well. So please do come back and dig in with my guests and me in the Visa Policy Sandbox. For more insight and practical advice from the Visa Economic Empowerment Institute, please be sure to visit us at visa.com/VEEI.